Washington, D.C. has been stuck on the list of weak rent growth apartment markets throughout much of this economic cycle. Is 2017 the year that momentum returns? We'll take a look at key trends for multifamily rentals in the nation's capital on today's apartment market dynamics from MPF Research. I'm Greg Willett.
And I'm Cameron McIntosh. Let's start our discussion with a look at what's happened with Washington, D.C.'s apartment rents since 2010. During the first couple of years of this period, local results were great. D.C. will outperform the nation as a whole. For the past 5 years, however, Washington has been a laggard. Total pricing growth since the beginning of 2010 is 14.2%, only a little more than half the U.S. norm. Specifically highlighting current results, D.C. rents are up 1.6% on an annual basis. That compares to 3.7% year-over-year rent growth nationally.
The slowdown in Washington, D.C. pricing power hasn't occurred solely because of aggressive building, but a notable upturn in completions certainly is a factor in the results. This is a place where long-term deliveries prior to the current cycle averaged about 7,000 units a year. Typical building in this cycle is close to 60% higher at an average of roughly 11,000 units annually. Activity peaked with a whopping 19,261 units finished in 2014. Deliveries in the past year totaled 13,263 units. That's certainly off from 19,000 units, but again, the long-term comparison point is 7,000 units.
Ongoing construction in Metro Washington comes in at 26,394 units. Projects targeted to finish in 2017 total 17,200 units, up 30% from 2016 delivery count. With that much new supply moving through initial lease-up, it might be tough for rent growth in top-tier product to even stay at the 1% mark seen now.
As in lots of places across the country, D.C.'s key question on the pricing front for the near term is what happens in those Class B and Class C communities. A competitive leasing environment at the top of the market doesn't necessarily have to trickle down into the middle market to bottom-end product. Price differences between product classes can be too vast for there to be much trade-out of residents between different categories of apartment quality. Take a look at these price points in Metro Washington. Average monthly rent in the Class A inventory is $2,250. That's 42% over typical Class B rent of $1,590. Thus, is any discounting in the Class A category ever really enough to put the units in a position to pull residents out of the Class B product? Probably not.
We've said in various presentations that operator confidence will have a big influence on the national rent growth results in 2017. Washington, D.C. provides a good example where that could come into play at the local level. The key numbers suggest that very solid price growth should be achievable in Class B and Class C developments, but what looks like some underpricing of those units has been fairly common of late.
Our base case scenario says that rent growth in Washington, D.C. moves to a level that's pretty close to the national norm in 2017, around the 3% mark. For that to actually happen, however, operators and owners in the Class B space will need to get somewhat more aggressive than they have been lately. We'll see whether facts or emotions get the upper hand in pricing decisions. That's our look at the apartment rent story in D.C. I'm Greg Willett. He's Cameron McIntosh. Thanks for watching Apartment Market Dynamics from MPF Research.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.